three legendary luxury brands are now teetering on the edge of bankruptcy. The warning signs are not speculation. According to a top executive with 25 years inside the industry, a single financial metric is flashing red, with a 94% failure rate when ignored. Flagship stores are shuttered, cash is draining faster than debts can be serviced, and yet the official story remains silent. Why are the world's most respected names preparing for collapse before 2026, and who will be hit hardest when the truth finally breaks? The executive at the center of this story is not an outsider looking in. With a 25-year career that began on the sales floor and ended behind closed doors with board members, this is someone who has witnessed the luxury industry's most sensitive moments firsthand. During the last decade, they have been present for emergency restructuring talks, late-night calls with creditors, and confidential meetings where the fate of entire brands hung in the balance. Their experience spans every part of the business, from overseeing expansion into new markets to negotiating with private equity partners and managing the fallout from sudden downturns. In 2024, this executive was invited to confidential strategy sessions as several iconic brands faced mounting debt and declining sales. They reviewed cash flow projections, flagged risks in quarterly reports, and watched as flagship locations in Milan and Paris quietly prepared for closure. When the Chinese market contracted by 40% in less than a year, they saw the panic ripple through boardrooms that had once been filled with confidence. This is not just theory or secondhand gossip. The executive's direct access to internal financial statements, legal filings, and crisis management playbooks gives them a perspective few others can claim. Their warnings are not based on rumor or speculation, but on patterns they have seen repeat across multiple collapses. In an industry built on secrecy and image, their decision to speak openly about what is coming next is both rare and revealing. The most reliable early warning sign for luxury brand bankruptcy is not a headline or a rumor. It is a simple number buried in the financial statements, one that insiders watch more closely than sales figures or social media buzz. This number is called the interest coverage ratio. It is calculated by dividing a company's earnings before interest and taxes, known as EBIT, by the amount it owes in interest payments each year. When the result drops below 1.0, the math becomes inescapable. The brand is no longer earning enough to pay even the interest on its debt. This threshold is not arbitrary. Lenders write it directly into loan agreements as a covenant. If a brand's interest coverage falls under 1.0, default clauses are triggered automatically. Banks can call in loans, demand collateral, or force asset sales, often with no negotiation. According to restructuring experts, this single metric has predicted bankruptcy filings with 94% accuracy across dozens of luxury and retail collapses in the past decade. Executives and creditors track this ratio quarter by quarter, knowing that a single bad season or an unexpected drop in sales can flip the switch. When EBIT divided by interest slips under that line, it is not just a warning, it is the starting gun for a financial endgame. For the brands now under scrutiny, their latest filings show the ratio flashing red, with earnings shrinking and interest obligations piling up. The countdown does not begin with a press release. It starts the moment the math no longer works. Shoppers in Milan pause outside shuttered doors where window displays once shimmered with new collections. The flagship boutique, a landmark on Via Montenapoleone for decades, sits empty. In New York, the Fifth Avenue store, once a destination for tourists and loyal clients, closed its doors in April 2025. Its marble floors and gilded fixtures left behind. Inside sources confirm that staff reductions began quietly months earlier. Sales associates, some with 20 years at the company, received severance letters as management slashed payroll to preserve cash. The brand's Paris location, long considered a crown jewel, now operates with a skeleton crew. Empty shelves and unsold inventory fill the back rooms. The company's retail footprint has contracted by nearly 40% in less than 18 months. Leases in Chicago, Tokyo, and Dubai were surrendered as executives scrambled to stem losses. In cities where the brand once hosted gala events and exclusive launches, only darkened windows remain. Even loyal customers have noticed the change. Emails bounce back, phone lines go unanswered, and promised repairs are indefinitely delayed. For a house that built its legend on Italian craftsmanship and personal service, the silence is impossible to ignore. The decline is no longer hidden in balance sheets or boardroom whispers. It is visible on the streets, in the empty spaces where luxury once lived. Interest payments have now overtaken the cash these brands generate from daily operations. In recent filings, high single-digit millions in interest expenses each quarter outstrip what is left after paying suppliers, employees, and landlords. The result is a financial vice. Every euro brought in is already spoken for, committed to lenders before a single new collection can be designed or marketed. Loan agreements spell out strict conditions, known as covenants, that leave no room for error. If a brand misses a single payment or if its financial ratios slip, banks can demand immediate repayment or seize assets, often with little warning. These covenants are not suggestions, they are legal triggers written to protect lenders, not the brands themselves. As sales fall and operating cash shrinks, the cost of debt keeps rising. Each quarter, the interest bill grows, fueled by variable rates and penalty clauses that kick in as soon as targets are missed. Executives try to buy time by cutting staff, closing stores, and selling inventory at discounts, but the math is relentless. With every failed season, the gap between cash coming in and cash owed widens. The cycle becomes self-reinforcing. Shrinking revenue leads to higher borrowing costs, which drain even more cash and force deeper cuts. At a certain point, the numbers show there is no path back, only the countdown to default, with lenders holding all the leverage. On the books, the French house still owns some of the most valuable retail properties in Paris and London, historic buildings that once drew lines around the block. But in the latest filings, the company's total market value has slipped below the appraised worth of its real estate holdings. Analysts now estimate the brand's equity at less than 900 million euros, while the combined value of its flagship properties exceeds 1.1 billion euros. Board minutes from May 2025 confirm that directors debated whether to sell the Rue de Faubourg Saint-Honoré building just to cover short-term obligations. Investors who once saw the brand as a safe haven are quietly exiting, selling shares at a loss as the company's goodwill evaporates from balance sheets. The stock price has dropped by over 60% since January, wiping out decades of accumulated value. Internal memos reveal that potential buyers are interested in the properties, not the brand itself, a reversal from the days when the name alone commanded a premium. The idea of selling off the physical heart of the house is no longer unthinkable. For an institution that defined French luxury for generations, the numbers tell a story of shrinking faith and vanishing options. Luxury's global boom always had a hidden dependency. Between 2010 and 2023, brands expanded storefronts from Shanghai to Chengdu, counting on China's appetite for status and exclusivity to drive double-digit growth. But by late 2024, the numbers told a different story. Industry analysts confirmed a 40% drop in Chinese luxury spending, both from travelers abroad and shoppers at home. The fallout was immediate. Sales projections, once built on endless demand, collapsed almost overnight. Brands that relied on Chinese tourists to fill boutiques in Paris, Milan, and New York saw foot traffic evaporate. Domestic sales in China, which had cushioned global slowdowns in the past, plunged as consumer confidence faltered and economic uncertainty deepened. Quarterly earnings reports from the world's largest luxury houses showed revenue gaps too large to ignore. Store managers reported empty showrooms even during peak shopping festivals. Inventory piled up in back rooms, unsold and rapidly losing value. Executives who once boasted of limitless growth now scrambled to revise forecasts and slash costs. The abrupt contraction exposed a systemic fragility, an entire sector built on the assumption that Chinese demand would only rise. With nearly half of all luxury growth tied to this single market, the sudden vacuum left brands dangerously exposed, unable to replace lost revenue from any other region. Private equity firms arrived with promises of growth, but their playbook relied on debt, not patience. When a luxury house changed hands in a leveraged buyout, the new owners rarely used their own cash. Instead, they borrowed 5, 6, sometimes 7 times the brand's annual EBITDA, transforming the company itself into collateral. Within 2 years, more than one iconic label paid out dividends to its new owners totaling 1.5 times its entire EBITDA. Cash that could have funded design, store renovations, or digital expansion siphoned off as profit. The logic was simple. Load the balance sheet with debt to finance the acquisition, then extract as much money as possible before the first downturn. Management fees, consulting charges, and special dividends all drained liquidity, leaving only the obligation to service swelling interest payments. When the market was strong and sales climbed, the model looked aggressive but effective. As soon as revenue dipped, the math turned lethal. Every euro paid to lenders or investors was a euro not reinvested in the brand. By 2025, these luxury houses faced a double burden: shrinking sales and debt so large that even a modest drop in earnings triggered covenant breaches. The cash that once fueled global expansion now lined the pockets of absentee owners. What remained was a shell, stripped of reserves, unable to weather a single bad year, and with no safety net when the market turned against them. Boardroom transcripts from April 2025 capture the moment when the most recognizable name in luxury began preparing for the unthinkable. The brand's directors, surrounded by legal counsel and restructuring advisors, debated how to manage mounting vendor panic as word leaked that credit lines had been frozen. For decades, suppliers extended generous terms, trusting the brand's reputation. Now invoices went unpaid for weeks. Some vendors halted deliveries entirely, unwilling to risk another shipment without cash up front. Internal minutes confirmed that liquidation scenarios were not hypothetical. The board commissioned asset appraisals and instructed outside consultants to model forced sale values for everything from inventory to real estate. In May, a confidential memo outlined plans to close another 20 boutiques by year's end, citing insufficient cash to cover basic expenses. Landlords in London and Los Angeles received termination notices, while remaining staff faced another round of layoffs. The brand's signature fragrance, once a staple in department stores worldwide, vanished from shelves as distributors demanded payment in advance. Behind the scenes, global banks assigned teams to monitor every transaction, weighing the risk of a sudden bankruptcy filing. For loyal customers and longtime employees, the sense of permanence was replaced by uncertainty. The liquidation clock had started. For the first time in its history, the brand's name was no longer a guarantee. It was a liability. On luxury resale platforms, handbags and watches from these brands now trade for as little as 15% of their original retail price. This collapse is not just a blow to prestige. It triggers a silent alarm for banks. Lenders treat unsold inventory as collateral, but when resale prices fall below that 15% threshold, those assets become effectively worthless on the balance sheet. Bankers reviewing loan agreements see the numbers in real time. A Birkin that once backed a seven-figure credit line now carries almost no lending value. As soon as this threshold is crossed, credit dries up overnight. Banks freeze lines, refuse to roll over short-term debt, and demand immediate repayment. Suppliers and landlords, watching the same market signals, tighten terms or walk away entirely. For the brands, it's a lockout from the financial system. No new loans, no extensions, no margin for error. The resale market does not just reflect consumer sentiment. It sets the terms for survival. When prices collapse, the countdown to bankruptcy accelerates, and every attempted fix only deepens the crisis. Marketing departments, desperate to spark a turnaround, poured millions into high-profile celebrity collaborations and limited edition drops. The returns never materialized. One brand cycled through 3 creative directors in just 2 years, each unveiling a new vision before being quietly replaced. Campaigns featuring A-list ambassadors failed to move inventory, even as marketing budgets ballooned. Behind the scenes, suppliers watched the chaos unfold and made their own calculations. Payment terms that once stretched to 90 days shrank overnight. By June 2025, key fabric and hardware vendors demanded cash on delivery, refusing to ship a single button or zipper without upfront payment. For brands already short on liquidity, these new terms choked production lines and delayed seasonal launches. The scramble for quick fixes, celebrity endorsements, flash sales, and creative overhauls only deepened mistrust. As bills went unpaid and orders stalled, suppliers began prioritizing more stable clients, leaving troubled houses with shrinking options and mounting costs. Every failed rescue attempt accelerated the countdown, pushing these brands closer to the edge. Court dockets from 2025 read like a warning for anyone watching the luxury sector. In March, Forever 21's Chapter 11 filing signaled the start of a steady drumbeat. By August, Claire's, with $496 million in debt due by 2026, entered its own bankruptcy process, its second in less than a decade. Lugano Diamonds and Jewelry joined the list in November, seeking protection while arranging a sale through the courts. Each case followed a similar pattern: debt outpacing equity, cash reserves too thin for a single missed payment, and creditors pushing for immediate action. For brands still standing, analysts point to a clear checklist. Survivors maintain low leverage and positive free cash flow, with balance sheets that can absorb a bad quarter. Their products hold at least half their value on resale, signaling real demand. They avoid overexpansion, keep inventory tight, and stick to a focused brand identity. In contrast, brands with excessive debt, collapsing resale prices, and constant executive turnover are flagged as next in line. The window for filing stretches from late 2025 through the first quarter of 2026, a risk period confirmed by both legal records and internal projections. For cautious consumers, the lesson is simple. Check the filings, watch the balance sheet, and treat every guarantee as temporary. Right now, luxury giants are learning that even 100-year-old legacies can vanish overnight. As global demand shifts and debt outpaces value, iconic names face the same fate as failed startups: irrelevance. McKinsey warns that nearly half the industry expects worse ahead. In this new era, brand prestige means nothing without resilience. The question is, who adapts and who disappears? Let me know your take in the comments below.